Welcome back to the Deep Dive. Today we're doing something really critical. We're taking a full inventory of the Carnelian 2026 outlook.
Right.
And this report is, it's really trying to reframe the entire conversation about where the market is headed.
It is.
Last year, they used this great cricket analogy describing 2025 as an overcast day.
A very overcast day.
It demanded a purely defensive stance. You had to protect your wicket at all costs.
And that prudence was absolutely necessary. What's so compelling about this new outlook is the confidence in the shift. They're now saying the skies are beginning to clear,
Right.
which suggests that whole defensive phase is over and a pivot is, well, it's imminent.
That is the core thesis.
Yeah.
They're predicting a huge shift from a phase of caution to a phase of opportunity.
Yeah.
So our job today is to really drill into the evidence. What specific policy changes are behind this? What sectors stand to benefit?
And most importantly, what are the potential traps for you, the listener, that might be lurking in this new landscape?
It's an essential deep dive, because if you only glanced at the financial news from 2025, you'd be fundamentally misled.
Oh, completely. The index performance, the headlines everyone saw, it was hiding massive, painful underlying weakness. A shallow dive just doesn't cut it.
Okay, so let's start right there with those misleading numbers of 2025. On paper, it looked like a pretty respectable year.
It did.
The Nifty 50, which is the big benchmark for large caps, it gained 10.5%.
And the broader BSE 500 was up about 8%.
Those numbers just scream health, but they hide a really dangerous truth.
They hide a crisis of breadth. This is the crucial reality check here.
Right.
We talk about market breadth as, how widely the rally is shared across different companies. In 2025, that breadth was incredibly weak.
How weak are we talking?
We're talking nearly 69% of all listed companies with a market cap over 100 crore posting negative returns.
69%. Let's put that in perspective for a moment.
Yeah.
The source material notes that just 1 year before, in 2024, only 28% of stocks declined.
It's a massive jump.
So the proportion of companies losing money more than doubled in a single year. I mean, that tells you that 3 out of every 4 companies were just left behind.
It was a brutal divergence. And if we break it down by size, you see exactly where the pain was.
Okay.
Even among the large caps in the Nifty 50, 36% of stocks were down. And the median decline for those was 10%.
Wow.
But the lower you went on the size curve, the worse it got.
I remember this feeling. The big names were kind of masking this hemorrhage happening everywhere else.
Absolutely. The Nifty Midcap 150 only scraped by with a 5.4% return.
Okay.
And the Nifty Small Cap 250, it actually delivered a negative return, minus 6% for the year.
A negative 6% return is bad enough.
It is, but the median decline in that Small Cap 250 was a staggering 20%.
20% median declines. Just think about that. That means half the stocks in that segment lost a fifth or more of their value.
Yeah. That's the kind of loss that makes you, stop checking your brokerage app for a while.
It really was widespread and intense. So what caused this?
Well, this environment was really created by 2 specific pressures that started in early 2024.
Okay.
First, a significant tightening of liquidity in the system, and that was compounded by pre-election spending constraints that slowed things down.
And those conditions naturally lead to slower corporate growth. What did earnings look like?
Very, very muted. For Nifty 50 companies, earnings growth is estimated to have been only about 3% year on year.
And this was all happening when valuations were pretty expensive to begin with.
Exactly. That brings us to the necessary correction. The Nifty 50 was trading at a peak of about 25 times estimated earnings.
That's a multiple that's pretty hard to justify with only 3% earnings growth.
It was completely unsustainable. So the multiples corrected. They came down to around 20 times on a trailing 12-month basis.
Which is much closer to historical comfort zones.
Much closer. And crucially, the mid and small cap segments saw an even sharper, more painful valuation correction. This meant your success in 2025 was entirely down to stock selection.
So what's the lesson here? In an environment like that, defined by high dispersion, selection was everything. How did a research-driven strategy hold up?
Well, the report highlights how a focus on quality really paid off, and it uses their compounder strategy as the prime example.
And how did that do?
This strategy delivered a 19% return and generated 11% alpha.
And for anyone unfamiliar, alpha just means outperforming the overall market benchmark. So 11% alpha is a huge win.
A huge win, especially when the broader market was struggling so much.
Right.
And the genius of it wasn't just the return, but what it proved. It proved that even in a terrible breadth environment, focusing on consistent, high-quality earnings companies like Loris Labs, AB Capital, Paytm, and Maruti, it offered genuine insulation.
But they also had a strategy for the tougher segments, didn't they?
Yeah.
The shift strategy targeting mid and small caps.
They did. That one faced significant headwinds, especially with the IT sector underperforming, and it posted a negative return of 3.5%. However, and here's the key insight, it still managed to outperform its benchmark, the BSE Small Cap Index, by about 2%.
So even where the pain was deepest, good stock picking could still find some alpha.
Small pockets of outperformance, exactly.
So we've established the pain of 2025. Now the market is always forward-looking. This whole outlook hinges on the idea that policy is turning the ship. So what specific policy shifts are we talking about here?
Okay, so this turnaround really rests on two major domestic pivots. The first is a very clear move towards a pro-growth fiscal policy.
Right, and the key document here is the FY26 budget.
Exactly. That budget was all about putting money back in the hands of consumers.
How so?
Well, it raised disposable income by increasing income tax exemption limits and reducing rates for middle-income earners.
And it went beyond just income tax.
It did. We also saw broad-based GST cuts on things like consumer durables and everyday goods.
The goal being a boost to consumption.
Right.
Both discretionary and essential.
Precisely. And that translates directly into stronger demand, which supports higher capacity utilization, which ultimately feeds into stronger GDP growth.
Okay, so that's the fiscal side. What's the second pivot?
The second massive pivot is monetary easing. This one directly impacts the cost of capital, which is, the lifeblood of business.
And the RBI has been pretty clear on this.
Unequivocally. They've shifted to supporting credit growth. They've cut repo rates by 125 basis points, that's 1.25%, down to about 5.25%.
But it's not just the headline rate cut, is it?
No, not at all. Beyond that, the central bank supported this with very targeted credit-stimulating measures.
What kind of subtle measures did they use to really lower the cost of capital across the whole system?
Well, they did things like reduce the risk weights on loans for certain sectors. They provided durable liquidity infusion into the banking system. They even deferred some stricter liquidity norms.
So all these moves together just make it cheaper to borrow money?
That's the goal. It improves affordability for consumers and corporations and provides the fuel for credit growth to really pick up steam in 2026.
Okay, now here's where the story gets really fascinating for me. The potential reversal of foreign investment.
FIIs.
FIIs, foreign institutional investors, they were huge sellers in 2025. Just how historic was that outflow?
It was a record, a flat-out record. FII's net sold nearly $18 billion of Indian equities in 2025.
18 billion.
It was the largest annual outflow ever recorded. It pushed foreign ownership of the Indian market down to a generational 15-year low of about 17%.
Wow. That selling had to be painful. What drove them out?
It was a mix of global factors. Initially, it was rising U.S. interest rates, pulling capital back to dollar assets.
And more recently?
More recently, it was capital rotating toward what was seen as deep value in the Chinese market.
Okay, but this whole outlook relies on that reversing. The big assumption is that U.S. rates will trend lower, which makes India more attractive. What if the Fed holds rates high for longer? Doesn't that just kill this thesis?
That is the main near-term risk, no question. However, the outlook argues that the risk-reward has already flipped, regardless of the exact timing.
How so?
Well, India's overweight status in emerging market funds has been cut way back by that $18 billion outflow.
Right.
So the perception is that the selling is mostly done. And any move toward lower global rates, even a slow one, will trigger a return because India's growth story is still superior.
So we have these powerful short-term catalysts, fiscal and monetary policy, but they're built on a bedrock of longer-term structural tailwinds. What keeps that foundation strong?
The foundation is robust because of long-term drivers that are independent of the business cycle. We're talking about crucial reforms like the simplified GST framework and ongoing labor reforms.
And the government's whole focus on manufacturing has to be a huge part of this.
Absolutely. The production-linked incentive schemes, the PLI schemes, are core to this structural shift.
Right.
And this, combined with the global China Plus One strategy, is successfully pulling manufacturing and supply chains toward India.
And you can see it on the ground with the massive infrastructure improvements.
Exactly. Huge investments in roads, rail, digital networks. They all increase the productive capacity of the entire economy. You combine that with a young population and rapid digital adoption, and you see why India is positioned as a reliable long-term engine for global growth.
Okay, let's focus on the near-term sparks. What are the specific triggers we should be watching for that could really move the market from caution to opportunity?
Three main triggers are outlined. The first is actually non-domestic.
Mm-hmm.
The signing of a bilateral U.S.-India trade deal.
Mm-hmm.
That would remove a lot of tariff uncertainty and could really reignite export growth in key sectors like pharma, textiles, and electronics.
Okay, and the second one has to be seeing proof domestically, right?
Correct. The expansionary policies we just talked about need to gain visible traction. We need to see domestic sectors like banking and consumer goods become the new market leaders.
Taking the baton from the previous leaders. And the third trigger is interesting. It's about global tech.
Yeah, that's the potential cooling of the global AI trade. If that high-flying tech enthusiasm slows down in the West, we could see a big rotation of capital towards markets like India that offers stronger fundamentals and, well, more reasonable valuations.
So let's talk about where investors should focus. If this cycle's really turning, the leadership is probably changing. Which sectors are expected to lead the charge in 2026?
We're looking at two main investment themes here. The first is centered squarely on the business cycle turnaround.
So, domestic focus.
A domestic focus driven by demand and credit growth. The early beneficiaries seem pretty clear. Banking, autos, especially commercial vehicles, and consumer-linked businesses.
That makes sense. Rates are cut, disposable income goes up, people take out loans, buy cars, buy stuff.
It's the classic playbook. And this also implies a shift in leadership. Sectors that led the last upcycle, like capital goods, might take a temporary backseat.
And what's the second theme?
The second theme is currency tailwinds. It leverages India's position as an exporter. The analysis suggests a gradually depreciating Indian rupee acts as a powerful tailwind for export-oriented industries.
How does that work?
A weaker rupee just improves their global competitiveness and boosts the margins for sectors that earn a lot of their revenue overseas.
So which export sectors are best positioned to capture those currency benefits?
Pharmaceuticals, for sure, IT services, and a specialized segment called CDMOs, Contract Development and Manufacturing Organizations.
Those are the firms that manufacture for the big global pharma companies.
Exactly. They benefit from both the currency tailwind and that structural China +1 shift we mentioned.
So we have a really compelling case for optimism here, but optimism has to be informed. It can't all be good news. What are the key risks?
Right. The outlook is very clear that three major risks need constant monitoring. The first is global slowdown potential.
A hard landing in the U.S.
A sharper than expected U.S. slowdown, yeah. A hard landing driven by high interest rates or even new tariffs.
A severe U.S. recession would definitely hit Indian growth and exports.
It would be a significant headwind. The second risk is closely related. Trade and tariff uncertainties.
Geopolitics.
Yeah, trade is increasingly being used as a weapon. There's still a lack of clarity on tariff policies, especially U.S.-China, and just as importantly, U.S.-India. Those tensions are still elevated.
Right. Any aggressive tariff action could really disrupt the supply chain shifts India is trying to capitalize on.
Absolutely. And the third major risk is just the generalized threat of geopolitical tensions.
Right.
Ongoing conflicts, Eastern Europe, the Middle East, or potential instability in critical areas like the Taiwan Strait could trigger a widespread risk-off sentiment globally.
And that kind of volatility could override even strong domestic fundamentals.
It could cause capital flight no matter how good India's story looks.
Okay, so to bring this all together for our listener, the core expectation for 2026 is that market returns will basically track corporate earnings growth.
Right, which the outlook projects in a very healthy 12 to 15% range.
That's the base case.
That is the solid base case. But then there's the possibility of what they call the magic event scenario.
The magic event.
If those FII inflows really materialize, if that $18 billion starts flowing back, that return of foreign capital could lead to an additional 3 to 5% valuation re-rating of the entire market.
So that could turn a 12 to 15% earnings return into a potential overall market return of 15 to 20%.
A powerful multiplier effect. But, and the report stresses this, regardless of whether that magic event happens, real outperformance is going to come from disciplined, research-driven stock selection.
So you still have to pick the winners.
You have to identify the right company's position for this new cycle.
You know, this whole environment where the Nifty was up but the broader market was crushed, it's giving me some serious deja vu. The outlook notes a strong parallel to 2022.
It's a great parallel. That year, the Nifty 50 delivered a modest 4.3% return, but the small cap index declined
Yeah,
13.8%.
big decline.
A huge decline. And what followed was a massive strong recovery. The Nifty Small Cap Index delivered over 84% returns in the period after that, which just underscores the power of mean reversion.
So if 2026 really does mirror that post-2022 period a year of narrow leadership, followed by a broad catch-up what specific segment is set up for the most dramatic mean reversion, and what does that potential comeback, especially for mid and small cap stocks, suggest for your investment strategy moving forward? Given the pain they took in 2025, the outlook strongly suggests these segments are where the biggest gains might just be found as the skies finally clear, something for you to mull over.